91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure.
The conversation around silver is shifting from cautious optimism to outright recognition of its explosive potential. When measured against gold, the ratios suggest levels that most investors can hardly imagine. Even at conservative benchmarks, silver looks dramatically undervalued, and the recent trend of large orders and institutional hoarding only adds fuel to the fire. At the same time, pressure on the US dollar and the structural imbalances in the financial system are exposing just how fragile the fiat model has become. Capital is moving away from paper wealth and into assets that hold intrinsic value, and history shows what happens when demand collides with scarcity. AndySchectman, a veteran precious metals analyst and CEO of Miles Franklin, brings together technical ratios, historical precedent, and the raw evidence of how wealth is actually moving in today's markets. He emphasizes that silver's story is not just about charts or speculation, it is about a global recognition that the dollar is in decline and that hard assets are becoming the refuge of choice for both individuals and institutions. Now, we present the clips from AndySchectman's interview with Liberty and Finance. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
You're seeing the numbers in all of vaults, except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But seven-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving. And the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote very possibly that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to really to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately, that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure. If you look at the amount of deposits held in banks, it's falling, which tells me the wealthy people don't keep their money in cash. They don't. And that's why they're wealthy. This is specifically why the wealthy people own assets. Because what has happened in the last 8 months? Gold's up 40%, the dollar's down 11. Look at the value of the dollar since you were a kid. I talk about this, I've mentioned many times probably on your show. When my parents got married in 63, my dad said he could live, he and my mom, on $6,000 a year, easy. And after a while, after saying that, I'm like, this can't be true. I just looked it up the other day. What is the average salary in 63 in the United States? It was 10 grand. So, he was just first year out of college. That's fair. And you could live comfortably, 2 people. I mean, how many people can live a month right now on 6 grand, or a week? I just think that the value of the dollar is dying, and it's starting to become exponential. So keeping your money in dollars is the worst thing to do. Assets would be far better. And what assets can you choose right now in a position just like this, where because of distortion in interest rates, these assets have all become gotten to a level where price discovery is questionable, to say the least. So yeah, I think that, and it's funny because gold and silver were the ones that were always held down in that environment. To support this illusion, remember, low interest rates, Gibson's paradox says low interest rates is completely inverted to the value of gold. So if you have low interest rates, you should have high gold, and vice versa. Well, if you're going to suppress interest rates and you're going to hollow out your manufacturing, you might as well kill the canary in the gold mine. And that's why they did it for so long. They stepped on gold and silver to support this illusion. And they're being called out on it now by sophisticated investors. It's coming to an end. You're going to see gold and silver continue to go higher, and you're going to see the dollar lose value. Remember, Stephen Mirren, who wrote the Mar-a-Lago Accord, who's on the Fed right now, talks about it. Trump talks about it. Besant is talking about it. They want a devalued dollar. They want low interest rates and a devalued dollar. In that environment, you get inflation, you get high asset prices, you get high cost of living, and easier to pay off your debt. You stay in dollars, you're going to go broke. And as Rick says, you're not a contrarian, you're damn well going to be a victim. This is the time. It's getting to that hockey stick stage part. And I don't know, do a little due diligence on your own, folks, and you'll see that a lot of what I'm saying has teeth to it.
Gold's surge is not simply a story of rising prices, but of currencies worldwide depreciating against it. What we are witnessing is less a standard bull market and more a monetary reset, an unmistakable shift in confidence. Central banks and foreign governments now hold more gold than U.S. treasuries, a powerful signal that trust has moved away from the dollar and into tangible reserves. Debt levels, soaring toward the mid-$20 trillion range, ensure more money printing and inflation, eroding the dollar's value further. Meanwhile, nations such as Russia, China, and India continue to promote trade in local currencies, laying the groundwork for a world where the dollar is no longer the default. Momentum continues to build as gold asserts itself as the benchmark against which other assets are measured. Even when compared over decades, gold has outpaced major stock market indexes, proving its strength as both a protection and a store of value. Add to this a growing call for Federal Reserve scrutiny and diminished independence, and the stage is set for an environment where gold advances while fiat weakens. This is a sober reality of capital rotation, one that comes only once in a generation. Let's get back to the interview.
Yeah, no one really is talking about it, which is kind of crazy. And, look, I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it makes my disdain for the legacy media grow by the day. Look, our massive debt means that we will almost certainly rely on money printing to pay it back, which erodes the value of the dollar. Foreign holders of our treasuries and our dollars do not want inflated dollars, so they too are shifting into gold. And it's because of the credibility, the liquidity, the physical security. This is what has shifted gold's bull run from 1,700 to 3,500 an ounce in just the last 3 years. And then at the same time, you got momentum building with guys like Putin and Xi and Modi, who are openly urging trade in local currencies, which again are laying the groundwork for a world less dependent on the dollar, done again. And that's, this is what it is. It's not so much gold, it's the dollar. It's everything. Gold is the barometer by which we measure everything else. And when you have a treasury that is projecting well north of 22 to 25 trillion in debt in the next several years, with our foreign creditors who have supported our lifestyle backing away, I don't know, isn't it always been the Fed that stepped in and with more money printing, risking inflation? I don't think this is panic. This is a sober reality. Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record. Speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And wouldn't surprise me. And then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. This will probably, I doubt people would get this, maybe people watching your show, but if you bought, what do you think was the best performing asset if you bought the day Nixon closed the gold window on August 15th, 1971? Well, obviously I'm asking the wrong crowd, but number one was gold. Number two was the S&P 500. Number three was the Dow Jones. Number four was silver. And this is including reinvesting every dividend for compounding gains, which no one ever does. Investors never do that. But if you had invested every single dividend for the past 54 years, gold is still outpaced the Dow and the S&P. Silver came in just behind those at number 4, but it goes to show the old adage that Wall Street wants us to believe that because there's no yield on gold, you should have known it. It's actually a joke. Yeah, in just about anything that you measure it against. In all valuations, don't measure it against the dollar, measure it against gold, and you'll see that in terms of gold, things are getting cheaper. And I expect that the price of gold only goes higher because, as Michael Oliver, who you have on your show all the time, he's talking about a real massive capital rotation from Western mainstream legacy investment stocks, bonds, etc., into precious metals. He says this happens but once only every 50 years. Doing a little bit of reading this weekend, found it very interesting that before Scott Bessent became the U.S. Treasury, he wrote this. I'm going to read it from his January 2024 Key Square Capital Management letter. And then I want you to think about where we are right now today and his role in all of this. We believe that this, and again, he was writing this for a letter. He was a capital management letter that he was working for in 2024. We believe that this inappropriately easy policy, monetary policy they're talking about, inflated the dot-com equity bubble. Our best case is that a re-elected Donald Trump will want to create an economic Lollapalooza and engineer what he will likely call the greatest 4 years in American history. In this scenario, here's the important part. The greatest risk factor, in our opinion, would be a sudden rise in long end rates. I find it interesting. I think this explains why he's so much into gold, and this is where we're going. This is the path that we are heading on. I also found it interesting that Bessent just also advocated for a comprehensive, independent review of the Federal Reserve. He called for scrutiny of the entire operation, its monetary policy, its regulation, its staffing, its communications, blah, blah, blah. He argues that the Fed has strayed beyond its mandate and needs to regain credibility as a non-political institution. He said that the Fed should relinquish its banking supervision duties and limit economic intervention, particularly unwarranted bond purchases outside of crises. But this aligns with President Trump's effort to increase influence over the Fed. So if that happens, you look at Stephen Mirren being put in and Trump's attempt to sever the independence, if you will. Isn't that exactly what Goldman Sachs was warning about? That the political control harms its credibility, increases inflation, undermines its trust. Bang, gold goes to 5,000. So it's happening right now. I mean, you can see it is being undermined. And so, I think that one should expect gold to go much higher in the face of a dollar going much lower and the Federal Reserve losing independence, as Goldman Sachs has so eloquently spoke of.
The trajectory of gold and silver today is not simply about price charts, but about what those movements reveal beneath the surface of the global system. As debt burdens climb and the purchasing power of currencies erodes, capital naturally seeks out havens that cannot be printed or inflated away. That is why the flow into physical metal, central bank accumulation, and even strategic ETF positioning all point toward a profound shift already underway. These aren't speculative ripples, they are signals of a much larger revaluation of money itself. Every major cycle in history has compelled a shift from paper promises to hard assets, and this one appears no different. The dollar's weakening credibility, paired with mounting fiscal pressure, is setting the stage for gold and silver to assume a far greater role in portfolios and even in the broader monetary framework. For those paying attention, the signs are clear. This is not noise. It is the unfolding of a generational transition in wealth. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.